We've quoted Warren Buffett before in the past when he said, quote, bonds should come with a warning label. But with the possibility that interest rates may go down at some point this year, has he changed his mind? According to Barron's, well, no. The Berkshire Hathaway portfolio was only 1% in bonds, and that part of the portfolio lost around $3 billion with a B dollars last year. Bonds are built for income and as a hedge against market losses. Where can you currently find those qualities if bonds aren't it?
Well, when you look at bonds, you think of the traditional asset mix. A lot of people that are listening probably have some type of target date retirement account if they have a 401k. And if you do, I think this is the segment for you. If you own things like a variable annuity, a lot of those variable annuities require some type of component to be invested inside of a bond. And bonds come with actually a lot of risk. In fact, if you go to Morningstar.com and you look at the aggregate bond index, even this year in 2024, as of May, that index is still negative this year. So, Warren lost in that example $1 billion on bonds last year when it's just a tiny part of his portfolio. If you look at some of these target date funds that are out there, they're not putting 1% allocation in bonds. They're putting 40, 50, 60% in bonds. I had a gentleman who come in the office the other day. We did an analysis on his retirement account. He's, about a year away from retirement. He's in one of those target date funds, and he feels like, I just never seem to be going anywhere in my account. And when we looked at the target date fund, what we found is that such the large percentage that he had was just a drag on his portfolio over time. So the question is are bonds really good for you? What you want to understand is what are the risks associated with bonds. One is that you have interest rate risk. And so where a lot of people have gotten clobbered with bonds in the last 2 years is because the interest rates have gone up so much. And when interest rates go up, bond prices generally go down. The perception is that interest rates are going to go down here in the future. And I might argue that it's not going to happen as quick as possible. We'll see what the Fed does. But that would be the argument that if interest rates do go down, then bond prices would go up. But I tend to agree more with what Warren Buffett. In fact, if you think about what the legends of investors have to say, it's well worth listening to some of the legends that's out there. And I would consider Warren Buffett, a legend of investing. Mm-hmm. With bonds, the other thing that people do is sometimes they want to chase the yield, meaning they want to go into some of these bond categories that pay a little bit higher interest. And if you look at, again, using the aggregate bond index, that yield right now is somewhere in the 4.8% range. And other investors, what they want to do is they want to try to get some of these bonds that yield 6, 7, 8% yields that are out there. And what that means is that they're going into more risky bonds. These are bonds that typically don't have as high of quality credit. And so if and when times get tough, you have a risk associated with that. The third category that's an issue is, some of the bonds have a call feature, meaning that you might have bought a bond that you thought you were going to have for a set period of time, and all of a sudden that bond gets called on you, and now you've got to reinvest it at what could be a lower interest rate. The fourth category is if you look at currency risk overseas, if you have foreign bonds in the portfolio. So, when you add these all up, that's why Warren Buffett talks about bonds coming with a warning label. That's the warning label. So what can you do as an investor? First of all, look at your 401k. If you have a 401k and you have a target date retirement account inside of there, and you're within 10 years of retirement, we really have to talk. We can show you our system on how to maybe pick an investment in your 401k to eliminate some of the risks that you have associated with it while still giving you some peace of mind. Now, how can you do that? In a 401k, you could have a stable value account. But what about us as other investors? So maybe, you're close to or in retirement time. Maybe you don't have a 401k anymore. Instead of bonds, what could be the other alternative? Number one, money market accounts. I still really like, the interest rate that we're seeing today. Talking about my son graduating from college, he's 20 years old, but we haven't seen money market accounts pay the rates that they're paying today. So for your liquid short-term money markets are great to look at. For money that you can set aside, in my opinion, anywhere from 6 months to 2 years, good old FDIC insured CD rates are really fantastic today. And for those of you that want to lock in rates, 3, 5, 7, 10 years, the Insurance Companies of America offer a product called a fixed and indexed annuity. And those rates are also still pretty competitive today. So the question about bonds is determining whether it's right for you. And if you really want to know, do you have the right investments? What you want to do is you want to get together with our office, America's Retirement Headquarters. And what we can do for you is we can do the Retirement Team Action Plan. Within the Retirement Team Action Plan, we're going to provide you with that independent portfolio analysis, and we're going to show you where the strengths and potential weaknesses are in your portfolio. And then we're going to give you some specific advice about if and when there should be changes made. What do those changes look like, and what is the pros and cons of that? So that Retirement Team Action Plan is a way to determine, are you owning the right investments, or should you be taking advantage of something else that's out there?
Nolan, so what I'm hearing from you on this is, diversify. Make sure you diversify your portfolio, right? Like you were talking about, and I think back about some of the 401ks that I had back in a previous life with all of the different companies that I worked for. I remember that bonds were definitely one of those items that you would pick from, right? And if you're the type that back when the interest rates were low, the bonds were paying decent returns, and you decided to put your money in bonds and you haven't changed your 401k portfolio, changing it out of something from the bonds to something else, obviously, like you said, make sure you reach out and get in touch with us. But you're not really saying completely eliminate bonds. Just make sure that you know what you've got and diversify your portfolio.
Yeah, definitely got to know what you own in this type of environment. So, just like anything, there's good and bad in what's out there, and it's a matter of understanding, what your options are. And if, again, you're in a target date fund, if you own a variable annuity, those are the two categories that I think investors have some of the biggest risk out there with some of the pitfalls that I see within the bond fund space.
So if you're worried about, market performance affecting your overall balance, but you haven't really looked at your quote unquote the safer side of it in bonds, might be a good time to take a look at it. And then if you find out that you are overextended or over allocated, finding out how to reallocate that. It is part of the Retirement Team Action Plan that the team at America's Retirement Headquarters can do for you. If you need a second set of eyes on it just to see what you have, pick up the phone and give a call. 419-794-3030. Once again, that's 419-794-3030. You can also visit them on the web. That's arhq.com.